Yeah, yeah.
So my co-host, Mr. Woods, is on. Um, he's gonna run the show today. So I'm giving him host privileges in a sense, so that he'll run the show today and let us and bring us up to some topics that that you may not know. So our topic today is, did you know? And then being Mr. Avi, you gonna be on for a while, or can we call on you a little bit sometimes? Because I know you know a lot of some of this information that he's gonna bring to us. And today is just an open forum. Everybody and out there that's on, if you can contribute, if you want to ask a question, we don't have no actual co-host guests on today. So it's just us and we just talking and we're going to bring it up. So Mr. Woods, let us know when you are ready and we will let you take control.
Okay, cool. Hey, I'm ready. I'm ready. How y'all doing out there today?
Hey, what's up, E? Yeah, I'll be here for a minute. I got another appointment scheduled. I'm still trying to get on this cruise.
Hey,
Yes,
look,
sir.
all us want that cruise. So yeah, that's an awesome thing. Hey, so yeah, hey, thanks for everybody that's coming out today, man. We're gonna have a good time with a conversation because a lot of people out there, right? They so caught up in how we were taught, to go to school for 12 years. After they finish school, a lot of people either go to the military or they go to college or they get in a field where they go a training, work in the field type of deal, or some people work in the family business. So with that being said, hey, what we're gonna do is we're gonna tap into the mindset of how the system has already started to make us basically work, from the age of 15 to 65. That's 50 years. But the whole concept was never built for us to become wealthy. So we're gonna talk about some key dates. The first thing we're gonna start off with, we're gonna start talking about how the Federal Reserve started monetary wise. You can't hear? You can
No,
hear
we
me?
can hear you. I can hear you.
Okay. All right. So, what the first thing I'm gonna do is I'm gonna play a short video right now. Hey, Miss Verna.
You need me to share screen?
Um, yeah, I'll do it. I'll do it. But just in case, just know you still got the actual videos we're gonna show. So the first
Okay.
video I'm gonna show is gonna be talking about the Federal Reserve. It goes back to it goes all the way back to 1913. And so we're gonna open your eyes on what the real thought process of how money is supposed to be versus how we think it should be. All right. So y'all bear with me. I'm gonna pull my video up. Can y'all see my screen? I'm gonna turn YouTube up. All right, so this first video that we're about to show, right? This video is going to show you how the start of the Federal Reserve started. It's called The Creatures of Jekyll Island. So if y'all can see my screen, bear with me and let's watch this and enjoy it, okay?
States was created in 1815 and then ended by Andrew Jackson, Jekyll Island. The battle over a central bank, creature from Jekyll Island. The battle over a central bank is an issue that goes back to the beginning of America. The Federalists, led by Alexander Hamilton, wanted the new American government to resemble the British Empire, with their own Bank of England. They were opposed by Jeffersonian Republicans, who understood a central bank to be a dangerous institution of corruption that would benefit a politically connected minority. Both sides saw their share of victories and defeats, leading to the establishment of the first Bank of the United States under Washington, ended by Jeffersonians in 1811. A second Bank of the United States was created in 1815 and then ended by Andrew Jackson in 1836. Older than any American central bank, however, was the dollar, which began as a Spanish silver coin widely used in the colonies. During the Revolutionary War, America tried its hand at paper currency, not backed by gold or silver. The result was the Continental Congress acquiring resources and military service from Americans in exchange for an unstable currency that collapsed in value. The result was, in 1792, the establishment of a national currency based in gold and silver. The new U.S. Mint would mold coins in a patriotic design, but the weight of silver remained the same as the Spanish dollar. With currencies around the world all backed by gold and silver, global trade benefited from what is called the classical gold standard. This international gold standard provided an automatic market mechanism for checking the inflationary potential of government. If a country, like Mexico, inflated their paper pesos, the inevitable result would be gold leaving the country when foreign banks redeemed their Mexican paper money for the proper amount of gold and silver. While the ability to redeem gold internationally imposed a level of discipline on national governments, interventions in domestic economies still managed to create the booms and busts we see in business cycles. Often, through some sort of government privilege, banks would be legally protected to print money not backed by gold, which would spur investment into projects that otherwise would not be profitable, resulting in a bust. After a particularly bad financial crisis in 1907, the result of bad banking policies first imposed during the Civil War, major Wall Street banks decided to promote the creation of a new central bank that could be depended on to bail them out during a financial crisis. The Wall Street bankers and their allied politicians understood that it would be difficult to get the American public to create such a powerful and dangerous government tool. In planning the creation of this new bank, they met in secret locations, like Jekyll Island, Georgia, using fake names. They plotted a national propaganda campaign to sell the public and elected officials on the plan by any means necessary. In 1912, Woodrow Wilson was elected president in a three-way race with less than 42% of the vote. A year later, he would sign into law the creation of the Federal Reserve. Shortly after, the costs of World War I would force governments around the world to begin massively inflating their currencies, which would result as the end of the gold standard. So, if the classical gold standard worked so well, why did it break down? It broke down because governments were entrusted with the task of keeping their monetary promises, of seeing to it that pounds, dollars, francs, etc. were always redeemable in gold, as they and their controlled banking system had pledged. Governments were incentivized to allow banks to print far more paper money than gold on hand than they could in a free market. It was not gold that failed. It was the folly of trusting the government to keep its promises. The Creature from Jack.
Okay, hey, so I'm gonna stop my stream. So this is the beginning of our conversation. We'll be talking about how the monetary system started. So I want y'all to hold that date and remember the date about the creatures of Jekyll Island in 1913. We're gonna go somewhere with this, but the next video that I'm gonna show you, we're gonna talk about the FDIC and how the FDIC was started in connection with the Federal Reserve. All right, so if y'all can view my screen, I'm gonna pull up my screen. I'm gonna check a video out about the FDIC, how it connects with the creatures of Jekyll Island, with them starting the Federal Reserve. All right, y'all bear with me because we're gonna connect all these in our conversation that we're gonna have today at the round table.
There are few ironclad guarantees in life, but here's one. Federal Deposit Insurance. Americans have counted on it since 1934. In those days, the insured deposit limit was just $2,500. Today, it's 100 times that. But the promise is the same. Whenever you put money into FDIC insured deposit accounts and stay within coverage limits, that money is 100% protected, no matter what happens to the bank or the economy. That's some guarantee to keep for more than 75 years. Here's how the FDIC is able to do it. Deposit insurance is exactly that, insurance. But unlike an auto or home policy, the consumer doesn't pay the premiums. Banks and savings institutions do. The FDIC is funded by the banking industry, not taxpayer money. The premiums go into the Deposit Insurance Fund. And as with any insurance, the higher the risk, the higher the premium. But what happens in times when bank failures are high and the fund is frequently tapped to protect depositors? There have been times when the fund has had a negative balance, even when it had abundant resources. This is because the FDIC is required to set aside a contingent reserve for probable failures over the next 12 months. The higher the projected failures, the greater that reserve must be. Since the FDIC is not allowed to offset that cost by future income, the net result on paper is a negative fund balance, even though total resources are positive. But whatever the fund balance, it does not affect the FDIC's ability to protect depositors when banks fail. The FDIC has access to considerable cash from many sources. Besides the money currently in the Deposit Insurance Fund, the FDIC receives quarterly premiums from the banking industry. It can also assess banks special fees and require them to pay premiums in advance. Then there are the unsold assets from failed banks. As these are sold, the proceeds are converted to cash. In 2009, the FDIC collected $10.2 billion in regular assessment revenues, plus another $5.6 billion in a special assessment. And at the end of the year, it required insured institutions to prepay 3 years' worth of insurance premiums. That raised another $46 billion. Based on current projections, the amount on hand will be more than sufficient to handle bank failures from the financial crisis that began in 2008. The FDIC is committed to doing everything possible to be solely funded by the banking industry and would only seek public funds as a last resort. In such an unlikely event, the FDIC has a $100 billion line of credit with the U.S. Treasury. And then there's the ultimate reassurance. The FDIC is backed by the full faith and credit of the United States government. No matter what the future brings, the FDIC will continue to be a symbol of confidence for America's banking public.
How the economic machine works in
Okay, I hope that y'all enjoyed that second video talking about the FDIC. You know, some of us play around with the dates. We usually say 1913, but it says 1934. It's not really about focus about the date. It's about focusing on how they were strategically starting to set up the system right before our eyes, before a lot of us were even born. And when I say this, you know, this is from the teachings of an awesome guy called Mr. Roger Grant A. So shout out to him. I want to give him a big caveat. But I want to show y'all one last video before we get off and start our conversation. So the first video was talking about the creatures of Jekyll Island, happened back in 1913. The first video was about 1913 Jekyll Island. The second video was about FDIC. This third video is going to be about the NCUA. Y'all follow me with this actually right now with these three things. I'm gonna show you how they're gonna connect when we have this conversation. All right. Hey, so let me know when y'all can see my stream. I'm gonna show you this third video, and then we're gonna get right off into this awesome conversation talking about the monetary system. Okay.
For more than 100 years, credit unions have provided financial services to their members in the United States. But what is their history? How did they get started? And what is NCUA? Before the mid-1800s, bank loans were a dream for most Americans. Unless someone guaranteed repayment, banks refused most loan requests. If misfortune struck, farmers and small businesses often went under with no hope of receiving even a modest loan to recover. The credit union movement grew from a simple idea. By pooling their savings and making loans to neighbors and coworkers, people could achieve a better standard of living for themselves and others. The credit union movement began in Germany. In 1848, Hermann Schulze-Delitzsch set up a credit society to serve shopkeepers and other urban workers who had been forced to pay very high interest rates charged by local loan sharks. In 1864, Friedrich Wilhelm Raiffeisen organized a similar cooperative for farmers. These early credit unions became the model for today's credit unions in the United States. The key principles of the movement were volunteerism, self-help, one member, one vote, consideration of a person's character as well as net worth. Alphonse Desjardins, a Canadian journalist, proved instrumental in bringing the movement to the United States. In 1909, Mr. Desjardins and Pierre Jay, the Massachusetts Commissioner of Banks, played key roles in getting the first law for organizing credit unions enacted in Massachusetts. They also helped organize the first credit union in the United States, St. Mary's Cooperative Credit Association in Manchester, New Hampshire. Edward Filene, whom many consider the father of U.S. credit unions, and his colleague, Roy Bergengren, a poverty lawyer, became convinced cooperative credit could work in the United States, a belief that was reinforced in a subsequent meeting with Alphonse Desjardins. Together, Mr. Filene and Mr. Bergengren advanced legislation to issue credit union charters in states across the country. In 1921, they also organized the Credit Union National Extension Bureau. The Bureau's main goals were to enact credit union laws, form new credit unions, and promote the general philosophy of credit unions. Through the 1920s, credit unions provided a source of inexpensive credit to purchase products like automobiles and washing machines. The popularity of credit unions grew because commercial banks and savings institutions generally showed limited interest in offering such consumer loans. By 1930, 32 states had adopted credit union laws with a total of 1,100 credit unions. In the aftermath of the start of the Great Depression, the time had come to create federal credit unions. In 1934, President Franklin Delano Roosevelt signed the Federal Credit Union Act into law, authorizing the formation of federally chartered credit unions in all states.
It means, I am sure, that the masses of the people of the nation firmly believe that there is great and actual possibility in an orderly recovery through a well-conceived and actively directed plan of action.
The purpose of the federal law was to make credit available and promote thrift through a national system of nonprofit cooperative credit unions. The Federal Credit Union section was also formed, creating a national system to charter and supervise federal credit unions. The credit union section was first housed at the Farm Credit Administration until it was transferred to the Department of Agriculture in 1939. The credit union section remained a part of the Department of Agriculture until May 1942, when the first War Powers Act was used to transfer the section to the Federal Deposit Insurance Corporation. As the credit union industry grew, the agency moved from the Federal Deposit Insurance Corporation to the Federal Security Agency, and then finally the Department of Health, Education, and Welfare. After 36 years of moving the regulatory function from one agency to another, Congress created the National Credit Union Administration on March 10, 1970, as an independent agency. In 1978, Congress passed a law to create the 3-member board that governs NCUA today. The National Credit Union Share Insurance Fund was also formed on October 19, 1970, to insure credit union deposits. In the independent credit union spirit, the Share Insurance Fund was created without tax dollars and capitalized solely by credit unions. Today, the Share Insurance Fund protects individual accounts up to $250,000 at all federal credit unions and the overwhelming majority of state-chartered credit unions. No member has ever lost a penny of insured deposits at a federally insured credit union. The 90s brought a strong economic climate, causing federally insured credit union membership to flourish. In 1998, President Bill Clinton signed legislation restoring expansion privileges and providing for multiple common bond credit unions, which allowed credit unions to increase fields of membership and mergers. In the years since the passage of the Federal Credit Union Act, credit unions have worked to offer loans and provide needed financial services to hardworking Americans. Today, federally insured credit unions have more than $1 trillion in assets and more than 100 million members. NCUA and its more than 1,000 employees continue to work to protect and enhance a credit union system that is safe, sound, and secure.
Hey, I hope that y'all enjoyed those videos. I know that last video was kind of a little bit lengthy, but I wanted to get the point across from the 3 videos. We talk about the starting of the Federal Reserve in 1913, the FDIC in 1933, 1934, and of course the official National Credit Union started in 1970, like the last seal they had on it. What we know as today credit union system. But the reason why, I brought this to the stage is because I didn't know the history of money prior to, getting this education by being in an awesome financial group that I've been in for the last 4 years. And I'll tell you, I used to think that, cash money was everything. Now, don't get me wrong. We got a saying that, cash, cash is king, but credit rules the kingdom. Okay, but think about this. What if we knew that the game was being played on us way back at the start of 1913 and even before that? Because if you notice, a lot of the areas wasn't a lot of the areas across the board wasn't together and united when they first started the monetary system. There were a lot of loopholes that went on. And this is why they formed the structure, so they can actually have control over the monetary system. So think about it. Now, when I say that, meaning that the thought process of how we view money is at a smaller scale than we really think. Because think about it, that paper currency that we see go around, from like the $1 bills all the way to the $100 bills, if they're not really actually physically in the bank, they don't have no true backing. You know what I mean? So I always give I used to give a metaphor about what's real money and what's not, but not only just what's real money and what's not, it's about the case of where you putting your money. Because think about it. They show all those pictures of the Federal Reserve and the FDIC and in the credit union, and you seeing people putting their hard-earned money in there. But never once in school that they told us that that same money that we work so hard for, we need to find a way to make the money really truly work for us and not the banks and the institution that we were just talking about. Okay. And when I say that, I'm not knocking, those institutions, but they never told us that we wasn't going to get, a better interest rate than what they've been giving us ever since before our great grandparents were even born, So my question to most people out here today, the first question I want to bring to the table is this. If you knew what you know now based off of watching those actual videos, that you know, a system was set up for the money to circulate basically back in their circle, would you cut out the middleman and start your own bank if you knew that, you know, the bank, and it said alone, and it caught my eye. Now you gotta think, that video that we just saw, that wasn't a video that was up to date. That was some years back. They said it's $1 trillion industry with the actual National Credit Union Administration. So think about this. If you could actually be able to make those numbers like how the banks were making, would you cut out the bank and you would go straight to who actually back in the bank? That's the first question that I want to ask everybody out there. If you knew you could make the number that the banks are making.
I know for sure that I would be putting my money there if I could cut that middleman out. It's like going to, you know, like you could buy stuff wholesale and retail. And if you go straight to the manufacturer, you could buy it, you get it at a better rate and a better price than if you go to the department store. So that's what I think about when you talk about what you're talking about with the bank. I'm not going to the middleman, I'm going straight to the warehouse or the manufacturer.
Exactly. Now, this is the thing. We were never taught this in school. This is something that I learned by learning specific education, by being with this financial group that I've been with, you know, for the last 4 years. And some people see me now and they look at me funny. Like right now, I'm in my hometown right now. Hey, shout out to Kingston. I'm over here at a location at home. And when I come home, people look at me like I'm strange. Like, why he coming into Burger King? You know, that's because it's a public place, right? And, you know, I wanted to enjoy a meal, which I'm going to write that off, you know, and they look at me like I'm a ghost. But in reality, I'm the same young guy, but a little bit older, you know, that grew up in this place. But the specific education has me, you know, doing things differently. So the information that we're putting out right now is definitely worthwhile of putting it out, because there's a lot of young kids, right? And metaphorically, I want to say this. I'm gonna ask everybody a question out there. We got like 4 people online. If I was to give you $1 million in a briefcase, right? And I would, you know, I'll give you $1 million in a briefcase, and then I would give you $1 million in land, and I give you the deed to it. And I tell you, hey, look, I need you to hold that for 1 week. Once the week is up, right, I'm gonna come back. When I come back, I got some bad news for you, right? I'm gonna come back, and this might sound crazy, but this is a metaphor that I'll talk about to get people to open their eyes. Is if I come back with some gas, a gas can and a lighter, and I tell you, hey, look, that briefcase of money that I gave you with the cash in it, I'm gonna have to, you know, burn that up. And that land that I told you the deed was worth $1 million, I'm gonna have to go physically go to this land and burn it up, right? Which one would still have value if I burn each one up? And this is just metaphorically. I'm not gonna go do it, but I'm saying metaphorically. Which one still holds value? The cash or the land?
More the land. Because
Okay.
the cash gonna be gone.
Hello, but think about this. But didn't they just say that the banks back the cash that goes through the banks? Keyword, through the banks. But when it leaves and it gets in my possession and it gets burned up,
It's gone.
it don't got no value.
It's gone.
So where's the game getting played here? But if the land got burned up, it still has, you know, value, and it can replenish itself. You know what I mean? So what is true monetary value? You know what I mean? Now, to flip the strip on that, think about a lot of our young kids out here. They so caught up on running after cash, 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 and that's fine. But when they get the cash, they never was taught in school when they get some cash in order for them to be able to take some cash and make them some cash go out there and work for them. This is some of the stuff that we've been learning, you know, with this awesome, you know, wealth group, the Wealth Syndicate, that we've been dealing with. But this is the thing. When are we going to start passing this information about the history that we were just talking about? You know, how the Federal Reserve was never set up for us to be wealthy at all. Because in truth be told, one of the gentlemen that, you know, actually helped set up the actual system, he actually was a part of the education system too. It was one of the, you know, don't quote me as one of the Rockefellers, Rothschild, one of those, you know, he quoted and said that they wanted, you know, the working class people to work in a childlike mindset for the rest of their life, their children's life, and their children's life. Make it make sense, y'all. They didn't teach us this in school. But people always ask, hey, how much money you got in the bank? Or you put your money in the bank? You know, stuff like that. But let me tell y'all something. Some of the people that came before us that they're no longer with us, they used to hide their money. They used to hide their money and not put it in banks because they knew something that we did not know because we wasn't taught. Now, this game that's getting played on us.
Public information. We got that public education,
Yeah.
but other people were getting private information. And that's the thing when you were saying that select that specialized education, we getting that private education now. And that's what we do here at the round table. We try to give you that private education.
Exactly. That's what I'm talking about. It hit way different because let me tell you something. I thought I was doing something with the system that they gave me, the system that I grew up in, the system that I was educated in, you know, until I found this education that they be talking about, that they be passing down from generation to generation. And I'm like, man, so here I am, 40-something plus years old. And I'm like, wow, I'm having an awe moment. I'm having an awe moment. So think about this. A lot of things that we learned monetarily was what they wanted everybody to know, the masses in public, same difference, same deal. They wanted the masses to know. But when you was gonna tell me how I could stop, how I, you know, could stop struggling and stop stressing about a job that don't care about me, you know what I mean? And get some of this money that the job's been giving me or this actual profession's been giving me and make it work how, you know, how the FDIC and actual, the National Administration is working the money for the banks. But it gets deeper. Think about this. Now, I didn't put this on the slide, I didn't put this in the video, but there were a lot of different ways that we were, you know, conditioned, even to the fact, you know, I was on a briefing a couple of days ago and I was listening to my mentor, a shout out to Mr. Ivory, that when he filled out his W-4, the form that you fill out when you first start working, did you know that that W-4 automatically locked you in to be able to pay the government, you know, wages from your check forever? But if you never signed an actual W-4, then that means you never really acknowledged that you had to pay taxes. I'll wait. So
that's that public education, huh?
Yeah.
That was that private education.
Yeah, that's a private education. Now, I didn't know until, you know, I was getting this specific education from the private sector being passed down, you know, from member to member. That's how we do. We pass it down from member to member. And I try to tell people, like, the education alone The education alone will make you wealthy. So think about this. Some people actually had a big bang theory about how the monetary system was doing them when they got their first check. They got their first check. Why does our check why do our check have, gross and net on it? Why shouldn't it just be one set line of this is what you get paid and that's what it is? But they say, oh, this is gross and net. Why don't you just say, this is the part we're taking from you and this is the part you get. This is the part that the government's taking, this part getting. You don't got to be using all these different words to confuse somebody. You have to know the definition of gross and net to understand that. Think about this. People first check that they got. 4 things came out of their check. They didn't even know this was going to come out. They was happy to get that first check. Even I was happy to get my first check. First job was at Taco Bell. Shout out to Taco Bell, man. Hey, them tacos was good. And y'all gave me a good job so I could make an honest living. But them 4 things hit me. Didn't know state tax was coming out, federal tax was coming out, FICA, and Social Security. Not alone, some of those companies will make you pay for your first uniform, and they would take that out of your check. So now, if you was working an hourly wage back then and you was making about $6 or $5.50 or whatever, and we usually don't do math in public, but if you worked 10 hours and you was getting paid $5.50 or whatever, we know that's like 50, 60 something dollars, we're gonna round that off to or whatever. But let's say you owe every time you get paid, let's say in your uniform was probably $75, you had to pay $25 for your uniform until they get that money, recoup that money back. That means 3 paychecks, you're getting $25 took out of your check. But you ain't even making nothing but between 50 to 100 something dollars. So you're getting 25 took out. And on top of that, still with them 4 thieves, state, federal, FICA, and Social Security. This still goes all the way back to the system that they got in place. I'll wait. So when we be seeing our brothers and sisters, and when I say brothers and sisters, I'm talking about the brothers and sisters that haven't got adapted to this private education that we be having, that we talk about, and we actually applying it, because there's a difference in knowing knowledge about how the monetary system is doing they thing, but you losing is we got to talk about it and apply it, not just talk and don't apply it. People that have the positive information that they need to be better financially and not using it are just as negative as a person that's not even listening to it. I'll wait. You got to apply it. So this whole actual conversation today is about understanding from once we came financially to where we need to be at financially. So now when I look at a brother and a sister, and this has nothing to do with color, there's people that don't have the information, that don't realize what's really going on. Now when I look at them and they say, man, I'm short, I need a little extra cash. Hey, come on over. I'm gonna send you this video. I have some information for you. And this is not it. And this is the thing. A lot of people always think sometimes when they see me or they see some of my business partners that they think, oh, well, they trying to get me into something. No, I want you to understand why your money is short. Everybody eating off your plate before you even start to eat off it yourself. That's what's happening.
Before you even dish it out.
Yes.
You cooking it and before you even put some on your own plate, they already dig it out the pot.
Yes. Hey, state taxing woke up this morning with you. Federal taxing woke up with you. FICA ain't woke up with you. Social Security ain't woke up with you. And they definitely ain't about to fix a meal or have the shower running for you when you get off.
Oh, they didn't even go to work with you. They didn't go work with you either. They didn't put them boxes on the shelf or drove that car or that bus wherever you needed to go. They didn't do none of that for you.
Or what about this? They not even gonna put gas in your car. And they the one who causing the inflation.
Yes.
Listen, the third thing that I want to say is this. Now that we have, you know, enlightened y'all on what's been going on before a lot of us were born, when you gonna take back your financial freedom? What is a good time to take back your financial freedom? Now, I already told you that there was somebody in a powerful place, they had a powerful position in the education system, I mean, running the education piece in DC back in the early 1900s, however you want to get, not, well, for some of us more, some of us maybe not, but they wanted us to work for our everlasting life in a childlike mind state. Even though we are adult, they want us working a child. I just told you I'm 40 something plus, however. And I'm like, I'm sitting with an aha moment. I'm sitting with an aha moment when I'm looking at this stuff. As every year go by, I'm learning more and more because I'm a life learner. Now I want to give a caveat. I'm not knocking a job. I want everybody to hear this. I'm not knocking a job, but a job is a platform that you use in order for you to get where you really want to be at. Okay, we got a slang say, hey boy, he done jumped off the porch, or she done jump. You got to jump off the porch from that job. Use them exactly how they using you. They using you for hours and wages. When I get my hours and wages, I'm gonna start to tell that money what to do for me, because I know I can take this money now and tell me, look, I done made you. And we had a short video, it used to be funny. I wish I could find it, but I'm not going. I wish I could find it. You remember that video, Ms. Verna, with the dollar bill, 5, 10, 20, and 50? And my guy was talking about how disrespectful a one, he don't really stick around. He be at the club. A 5, you don't even know where he at. 10, be looking for 10, he be with 20, and 50 and 100, they always be together. They don't never come home. You know what I mean? As soon as you get them, they just gone. You know what I mean? So that's that's the same thing on how some people just get numb to think it's okay that when you know that is you working for this hard, making this money hard earned, and thinking like, hey, you supposed to tell money what to do. Cause now let's just think about this. Let's not really get too hard in thinking about the reserve. Not too hard thinking about the FDIC, not too hard thinking about the actual National Credit Union Administration. Let's talk about this. Everybody was given a right of freedom of speech, freedom of a lot of things. Nobody ever told you that you can't tell your money what to do. So stop playing. Some people so happy and, oh, all my bills paid. You're supposed to do it. Or, yep, hey, I'm independent. Okay. Hey, I pay for my own place to stay. I pay for my own car. I pay my light bill, water bill, and food. You're supposed to be able to take care of yourself. But the problem is, you ain't telling your money what to do, though. But you independent, though. But you ain't telling that money what to do. The fourth question I want to ask most people is this. If you had more wealth, because most people, everybody getting income, but if you have more wealth, more cash flow, what would you be doing with your time? Would you have more time freedom to do things you really want to do? Would your stress level be down? That's the question I got for y'all out there.
Brian, I wanted to, I know it's video time and showing stuff, but we showed about the FDIC and those places that the banks put, I mean, how the bank is protecting their money. And we talked about cutting out the middleman and going straight to where the bank is putting our money. Well, let's show them that where the bank is putting their money. If you don't mind me sharing my screen, I'll bring up the video so that they can see.
Hey, I would love that.
Because it makes no sense to just tell people one thing, but don't shouldn't, because we all about giving you the whole information, you know, not just part of the information.
Hello, come on to the table. Are we coming with a solution?
Yeah.
Hello. Hello, I love it. You know, I'm about to sit back and relax. Hey, don't mind me if I be eating popcorn behind the scenes. I think this is gonna be real good. Real good.
Nice.
I don't know. I might get the Chuckstown Steppers out here for this one.
Give me 1 second. Let me pull up my screen. I mean, pull it to the right place. I need to move this from. I'm sorry, my screen is. Bear with me. I thought I had it open already.
Hey, you got this, Ms. V. Hey, this technology ain't got nothing on you.
So guys, we're gonna just show you, we told you about where the banks put their money, where the banks put our money. So we just want to show you these videos about that. Y'all can see my screen.
Hey, we can't see it yet, Ms. V.
You see you can't see my screen?
No, ma'am, I can't see it. All I can see is the stream where you were looking for something.
%. Somebody else, a remodel, they get 7%. And then there's somebody that needs. Then you're probably thinking.
You can see it now.
Yes, ma'am, I can see it.
Let me start the video.
Pretty simple question, Ike. They made 20%. I made 4%. 20 minus 4, they made 16%. Banks make anywhere. Have you ever wondered why your savings accounts get so little interest? 2%, 1%, 0.8%. Ugh. Through a method called fractional reserve banking, banks wait for you to make a deposit, promise you 1% interest, keep only a fraction of that money in the bank, and then loan out the rest for 5 to 18%. Let me give you an example. Let's say you found a bank that was going to give you 4% interest. Probably not going to happen, but let's just say you did. Somebody else needs a home loan and they get 5%. Somebody else needs a car loan, they get 6%. Somebody else a remodel, they get 7%. And then there's somebody that needs maybe a personal loan, they get 18%. The difference is 1, 2, 3, and 14% for a total of 20%. Now let me ask you a question. How much more did the bank make than you? You're probably thinking, pretty simple question, Ike. They made 20%, I made 4%. 20 minus 4, they made 16% more than me. How about 500% more than you? Because it's true that if you had $4 and the bank has $20, isn't that 5 times more than you? 500%. Banks make anywhere between 400 and 1,300% annually on the money that you put in there. Well, that's just the way things are, Ike. It doesn't have to be. With a diversified cash flow account, you can put your money where the banks do without locking it up, without having any risk of losing it, and without having to settle for 1%.
So that was one of the ways, or one thing. Let you see where the banks put your money, and now you can also put your money where they put your money, and look at what you can gain the same way how they gain. Let's share another video.
Wondering who else has used a diversified cash flow account? Probably not your friends. This has been a secret the wealthy have used for years. Or is it actually a secret? Do some of these names ring a bell? Walt Disney, Ray Kroc, J.C. Penney, Doris Christopher, Senator John McCain, and the list goes on and on and on. Although they're wealthy and famous now, most of them started using a diversified cash flow account before they got money, before they got their millions. Senator McCain used his to finance his desire to become president. Doris Christopher started her business with funds from her diversified cash flow account. The name of that business? Pampered Chef. Yes, that same business she sold for $1.5 billion in 2002 to billionaire Warren Buffett. Ray Kroc used his to finance the business we now know as McDonald's. Walt Disney used his to finance an amusement park we now know as Disneyland. And when the stock market crashed in 1929, James Cash Penney, better known as J.C. Penney, used his to fulfill his dream of selling dry goods in a retail store. Oh, and remember I said the list goes on and on and on? Some of those notable names are Jim Harbaugh, Rockefeller, Franklin D. Roosevelt, and John F. Kennedy. Yes, JFK. One more name that might not be as recognizable is Ben Bernanke. Who's that? The former chairman of the Federal Reserve. Federal Reserve? Yep, Federal Reserve.
Guys, we gotta put our money where the banks are putting our money. And you heard what I said, where they're putting our money. And these are just some ways that why you want to do this and how you can use that system to your advantage.
What if I could show you how to pay off all your debt, including your mortgage, in 9 years or less without spending any extra money that you're currently spending right now? A little skeptical? I understand, because this doesn't follow the ideas of Main Street media and Wall Street. But I bet your current plan does. And so far, for most people, that just isn't working. See, the system is rigged. And Wall Street, banks, big corporations, lenders, they're all trying to get your money over time. The worst part, it's working. Debt is an epidemic, with auto loan debt at 1.2 trillion. Credit card debt is at 1.2 trillion. Student loan debt is at 1.4 trillion. Mortgage debt is at 9.8 trillion. For the total amount of debt currently we're in right now, over $13.6 trillion in the United States. Bring it a little closer to home, the average person is $250,000 in debt, with 74 cents out of every dollar is going towards interest and taxes. So how do we fix this? Well, number one, you don't try to do it by yourself. Trying to get out of debt by yourself is like eating donuts your whole life and trying to go on a strict diet. What you need is help, and help comes right from the Diversified Cash Flow account. See, with this account, your money works twice for you. What that means for most people is we'll be able to show you a plan from the very beginning that can pay off all your debt, including your mortgage, in 9 years or less without spending any extra money than you're currently spending right now.
Brian, do you want to go ahead and show them more? Or are we gonna? We just want you to see that there's ways for you to do better with your money than what you're currently doing right now. I'm gonna go with this because this is most people their way. This is how they usually go and buy a car. This is how most people use their money. So I'm gonna go with this one first.
We've never met, but I know you. At least the way you purchase cars. When you buy a car, you either lease it, finance it, or pay cash for it. You take your money, give it to the lender, they give you the car. They got your money, you got the car. Not rocket science, right? That's what we've been doing our whole lives. What if you could add in one extra step? One extra step where they get your money, you get the car, except now you get all your money back. Sound too good to be true? Let's break down these options. Option one, lease it. This is actually the worst way to buy a car because there's a middleman involved and somebody has to get paid. Option two, finance it. You find a lender and then you pay them interest for the money they let you borrow because it was theirs to start with. And then there's option three, pay cash for it. We've all been taught this is the best way to do it. Work really, really hard, save up all your money, and then when it's time, take that money out of the savings and go buy a car. Over the next 4 or 5 years, we put 100,000+ miles on that car. It doesn't smell fresh and new anymore, and we're ready for a new one. So what do we got to do? Again, save up, take that money, and go buy a car. So you find the car you want, go in debt. Over the next 4 or 5 years, you pay it off, put 100,000+ miles on the car, and now you're ready for a new one. So what do? We start the process all over again, and we never see those dollars again. The problem with this is it continuously puts us back at zero. But more importantly, we lose our ability to have money compounding for us while we have it. Albert Einstein once said, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. We lose the opportunity cost that our money could have earned somewhere else. So you've been either that person that saves and spends, or that person that borrows from others and gives it right back. Option 4 is the Diversified Cash Flow account. And I want you to appreciate that the only difference between this option and option 3 is one extra step, making one little change in how you manage your money right now. This one extra step is the same step that most wealthy people have been using for years. Most banks, big banks, corporations, big business owners have been doing this same thing for years. They accumulate money, use it tax-free, all while the money they accumulate keeps growing. No, compounding, untouched and uninterrupted. Want an example? I got you. Watch part 2 and find out how the diversified cash flow account can help you get back all the money, all the cars you ever purchased.
So let's find out how. I hope you guys are enjoying this and that this is helping you.
If you haven't watched part 1, stop this video, go watch part 1, then come back and watch this video. Oh, you're back. Okay. This method requires 2 things. 1, diversified cash flow account. And 2, is patience. All right, here we go. And by the way, if you're not really a numbers person, put on your earmuffs because we're about to get geeky. First, we'll start with the traditional way. Let's say you financed a $30,000 car at 4.99 interest for 84 months, which would make the payments $424 a month for those 84 months, or call it 7 years. So every month you take money out, pay it to the bank. After 84 months, you've paid a total of $35,616. Now, you originally borrowed $30,000, but you had to pay $5,616 for interest. Now the car's paid off, you put 100,000+ miles on it, and you're ready for another one. Let's say the value of the car is still $10,000. That would mean over that time frame, you lost $25,616. Now let's take a look at the diversified cash flow account example. You've been patiently funding your diversified cash flow account, and now you're going to be able to use the money, go buy that car, and still have interest growing on the money that's not even there. What? That's right. You're going to be able to have interest growing on the money that's not even there. So Ike, you're telling me I put money in my DCA, diversified cash flow account, I take the money out, and I still have interest growing on the money that's not there? Yep. Let's take a look. We're going to take the same $30,000, same 84 months, same payment, $424, and we still paying interest. So 4.99 interest. The only difference is we're going to gain interest on that $30,000 while we use it to make our payments. So after 84 months, we paid the same thing, a total of $35,616. However, who's in control of the money now? We are. See, we're in possession of the money. All we basically did is take money from our left pocket and put it in our right pocket. Now, the car's paid off. You put 100,000+ miles on the car. You continue to patiently fund your diversified cash flow account, and guess what? You're ready for a new car. The only difference is now you have the $35,616, and you still have a car that's worth $10,000. So if we sell it, we have a total of $45,616. See, the traditional way, we were losing $25,616. And with the diversified cash flow account, we have positive $45,616. That's the power of the diversified cash flow account.
Guys, I hope you guys have enjoyed that video or those videos. And here at the Roundtable, we don't just want to bring you the information, we also want to give you the solution, because it's nothing like having information and still don't know how to use it. So what we want to do is be able to give people information so that they'll be able to apply to their life those things. And let people know that the things that you hear about here on the Roundtable, they're possible, because the people that we also bring to the Roundtable, they're doing it. So I'm going to say this in reference to the diversified cash flow. Once I heard this information from the platform that we were on, the platform, the group that we're in, the people who are educating us, giving us that private information, I went ahead and I opened myself a DCA. because I understood that. To me, that made sense and that made logic. I put my money somewhere where when I pull it out, it's as though it's still there, gaining interest as it's there. And as I use it, I'm paying myself back because I'm the bank. I can pay myself back, because if I had borrowed it from our traditional bank, I would have had to pay it back. So I have some credit cards that I want to pay off. And most of the time, what we do with credit cards to pay them off is we pay more money on top of them than the minimum payment. Because if you pay the minimum payment, we all know we're going to be in debt for a long time. Correct, Ms. Woods?
Hey, you're exactly right, Ms. Verna. And you know, the thing is, like I said, you know, earlier, that I was in an odd moment when I got this information. Like, I'm telling you, I thought that I was doing it. I thought I had it going on with a bag of chips financially, until that other light bulb came on with the private, you know, education I've been learning with this awesome financial group that, you know, I'm a part of. And I want to thank the person who thought enough of me to invite me to show me this information. And I tell you, they had the answers to what I was hurting in financially. I used to have to pay back the IRS every single year. You know, I had came out of a divorce, and you know, it looked different. To the world, it looked like, okay, this guy's doing well, you know, I'm in my career and everything. But it changes when you still got responsibility. But IRS looking at me like, hey, this guy right here need to pay us because he make too much money, he's single. You're not looking at it, I still got responsibility. They don't care. So earlier when we was talking about you need to find out how to make money work for you, money don't get tired, money don't go to sleep, it don't complain. But you know who be complaining because it could put wear and tear on their body? The person who looking in the man in the mirror or the woman in the mirror. Let's apply the knowledge that we actually talking about today. And when I say that, apply what works for you. But one thing we always say, when we have our meetings is you can't unsee what we're about, what we showed you. And you can't unhear the things that we're talking about. The only thing is this, we want you to go out and apply. And not only that, pass the information. Because a lot of people depending on you because they looking at you like you understand everything financially, but you ain't even giving them the information that you learning for them to actually use it. Because you might say, I'm good about talking about this money stuff. But let's face the facts. I ain't never known nobody got sad about receiving some money unless it was somebody passing and they rather have the time with the person that passed versus the money. That's the only time I ever seen somebody got mad about, receiving, or they got shorted. But the thing is, a lot of people been getting shorted their whole life.
Their whole life.
But you ain't mad at them 4 thieves. You ain't mad at that whole system that's been being around on us before all of us was born. Because everybody on the stream right there, ain't nobody on the stream right now was born in 1913. If you are, I want you to come off mute and tell us how you was making it for them almost, almost. You was making over 100-something years and the game been being played on you and you ain't been using it. So, Ms. V, if you got any more questions or any more game you want to drop before we close this out?
No, because we already went over our time. This topic was so good, we went over our time, and we apologize for that, but we like to bring you the information, and we're not going to shortcut you. If we don't want to shortcut you, but we don't also know time is not money. Time is more valuable than money. So we want to get you that information. We pray that you have taken some notes and that you view this information that we have passed on to you and you go out there and apply it, because we want to see more more of our family members, friends, acquaintances, and those of us those family and friends that we haven't met yet, we want all of us to be able to be doing the same thing, which is being on the top, on that beach, because we ain't going to the banks no more.
Yeah, I concur. Hey, so with that being said, hey, Ms. Verna, hey, you want to close this round table? Hey, I can't wait for what we about to do next on this next.
And the next one, please.
Okay.
Stay live. Next time we will have the round table on its own Zoom, on its own YouTube channel. It is out there. Please, it's the Cash Flow Round Table YouTube channel. Please go like and subscribe. Hit that notification button so that you can get the next time our video we post a video. So please go and follow us on YouTube. And we thank you guys for being in the audience. We thank you for your support, and we will see you the next time on the round table. Peace.